Welcome, you're watching Friday's edition of Inside India. I'm Sri Jegarajah. Here are your headlines. Some Independence Day cheer for India as S&P upgrades the country's sovereign credit rating for the first time in nearly 20 years, giving the South Asian country a bounce in its step as it aims for developed economy status by the year 2047. But it also comes amid a very challenging outlook and a very challenging time for trade ties. India firmly in President Trump's crosshairs, with a risk of higher penalties for its Russian dealings if President Trump's meeting with Putin in Alaska today does not go well. But big Indian oil remains unfazed, saying they're not pausing Russian oil purchases. Welcome to the programme. Let's take a look at the regional markets and see how they are rounding off the week. And a fair degree of divergence. The Straits Times, the index, domestic index here in Singapore, down by 1%. The Nikkei, however, is up by 1%. The Hang Seng performing badly, down by 1.3%, making it the relative laggard at this stage. Now, moving on to India, you're not seeing any quotes for the benchmarks, of course, today because the Indian markets are closed as the country marks its 79th year of independence from colonial rule. You're watching live pictures of the celebrations, and Prime Minister Narendra Modi hoisted the national flag this morning at the Red Fort in the capital, New Delhi, and is currently speaking his key themes and messages: self-reliance and regulatory reforms. Prime Minister Modi also talking about the prospect of reforming GST by Diwali, so laying out a time frame for systematic GST reforms. That just in, by the way. And a nod there from the Prime Minister on the upgrade to the long-term credit rating that we just heard from S&P. So, moving in the right direction in terms of the macroeconomic picture, but challenges, of course, do remain, especially on the external front, with the risk of 50% tariffs. And also, there are issues related to the domestic economy and the pace of reforms, especially when it comes to structural job creation. Let's leave that aside for now. All eyes on the geopolitics in Alaska today, where President Trump meets Russian President Vladimir Putin to discuss the war in Ukraine. President Trump says Putin is ready to make a deal, but any peace would need a second meeting involving Ukraine's leader, Vladimir Zelensky. He's also warning of more sanctions if no solutions are found. India, of course, is already feeling the heat, facing higher US tariffs for continuing to buy Russian oil, which President Trump says is funding the war. Back to one of our top stories. S&P Global Ratings has upgraded India's long-term sovereign credit rating to BBB from BBB- with a stable outlook. This is India's first upgrade in 18 years and comes at a time when the country is facing a 50% tariff on exports to the US. S&P, though, believes the tariff impact is manageable, given India's reliance on domestic demand. The agency citing strong growth, credible monetary policy and steady fiscal consolidation. S&P also sees India's debt to GDP ratio falling to 78% by the year 2029. Rupee and bond markets rallied on the news, with officials calling the move a boost to investor confidence. Let's bring in Sonal Varma now, Chief Economist, India and Asia, ex-Japan at Nomura. Sonal, welcome to the programme and thank you very much indeed for joining me. First of all, given the balance of external and domestic risks, I know that we've talked about this ad infinitum. Do you feel that growth in the region of 6.2, 6.5% is at risk?
I think for FY26, it's potentially at risk. Our baseline is 6.2%, but that assumed actually an effective tariff rate of less than 15%. So with the 25% plus a 25% penalty, the effective tariff rate on India goes up to almost 34%. So the impact on the labor-intensive exporting sectors, on employment, on their profitability, their investment profile, I think a a lot of that is ahead of us. So we do think there's downside risk. Currently, we are flagging a 20 basis point downside risk, but it could be more depending on how the US tariff situation settles.
We're also hearing Prime Minister Modi ji talk about GST reforms. How important is this in the greater scheme of macroeconomic management and the fiscal story in India?
I think it's a very important step and one of the many reforms that India needs to do. So since the GST was introduced, there are still a few pending things to do. One is to reduce the number of tax slabs we have under the GST. There are quite a few, so we want to trim that down to maybe 3 or 4. And second is to increase the coverage of GST. So there are still products like petroleum, etc., which are actually outside the GST tax net. So if we bring in more products into the net, then the ability to actually reduce the GST rate across more products will also be much more. So from a efficiency as well as revenue generation perspective, I think that's an important move.
Do you excuse me, do you feel that this credit rating upgrade by S&P on the long-term credit profile was deserved, given the balance of risks out there affecting India potentially?
Well, I do think it's deserved because, credit ratings are not just about the next 6 to 12 months. It's more about the next 4 to 5 years. And if you look at the last 4 to 5 years, India has actually showcased a commitment on fiscal consolidation. A commitment in terms of the quality of fiscal consolidation and to the monetary policy inflation credibility framework. And broadly, the direction has been more supply side reforms, more infrastructure spending. So, and ratings at the end of the day is a relative ranking. So when we compare India to other peers, even in the region, India was ranked lower. So yes, it was well deserved. Of course, the timing was a bit of a surprise given we are trying to reckon with the tariff impact. But definitely a much needed step.
And the tariff impact is still very uncertain as to how that is going to ultimately affect the external side of the equation, and there are concerns that unemployment could rise if textiles and the gold industries are hit hard and will have to lay off people. Do you feel, Sonal, then, that the finance ministry is going to have to step up at some stage the fiscal impulse if there is a deeper growth scare down the road?
I think there are sort of multiple things that the government needs to do and probably will do in the coming months. First of all is supporting exporters in the short term. Whether this is a 1 month hit, 3 month hit, 6 month hit, one doesn't know. But the cash flow impact on exporters will be quite substantial. So that requires actually some sort of interest rate subvention, duty drawback schemes. Exporters will need actually working capital support. So some of this is actually fiscal intervention by the government, but typically the cost of that on our estimate is less than 0.1% of GDP. A lot of this is also going to be bank-related funding support. Second is, from a more medium-term perspective, is to diversify the export basket. So finding new markets, signing more FTAs with other countries, that's important. And third is continuing on the pace of economic reform. So, deregulation, some of the product market reforms, the GST change that you were referring to. All of this is part of a package to essentially give the signal that India is still open to business to other countries and is still wanting to essentially reform the internal markets and to align more globally. So I think we'll see a mix of many of these measures in the coming days and months.
And there are implications, of course, for the mighty Indian consumer if GST rates are coming down. We'll talk about that part of the economy later on in the programme with you, Sonal. Thank you. Sonal Varma stays with us. We're back in 2 minutes. Welcome back. In India, a rare twist in an antitrust case. Top executives from FedEx, UPS, DHL, Aramex and DTDC will be cross-examined over alleged price collusion, despite being cleared last year. This after a group of book publishers convinced regulators that the probe ignored anomalies such cross-exams are unusual and could change the outcome. The $14 billion courier industry is growing fast, but now faces fresh scrutiny. The hearings begin in the coming weeks. Let's return to Sonal Varma from Nomura. How do you think foreign investors and long-term sticky capital is viewing and holding up, given the balance of risks associated with India right now?
So if you think about like foreign portfolio investors, I think there were a couple of concerns for them. One is valuations on the expensive side. And two, the domestic demand itself, even before the US tariff hit, domestic demand has been softer than expected. So we had seen outflows from even portfolio investors. Of course, that accelerated after the tensions built up. From the FDI investors' standpoint, I think the MNCs who were looking to put capacity in India to meet US domestic demand, the tariff actually puts those plans into question. So I guess, you know, they would be putting those plans on hold. But the MNCs that are catering to other markets, you know, whether it's Europe or other parts of Asia, I think would still continue to invest in India. So we could see some short-term pause on FDI, but I don't think it's a complete stop.
Turning to inflation, Sonal, at an 8-year low, the recent data told us. Does that tell us, I mean, there's reason to celebrate low inflation, of course, but does it also tell us that the type of good inflation, demand pull, is simply not there in the Indian economy? And how concerning is that from a growth projections point of view?
Is very low for a country like India, where, you know, the last 10-year average inflation has been closer to 4.5%. So this is below average inflation. And what we are seeing right now is actually a combination of a positive supply side shock and a negative demand shock. So on the food side, of course, we've seen excess production, which is leading to lower food inflation. And of course, oil prices are down. But on the demand side as well, domestic consumption is weak, private capex is soft. And there is also the competition from China's overcapacity. So the mix of factors that are leading to low inflation. I think it's important for India to have a good balance on inflation, because if you have very low food inflation, that can also be negative for food producers. So currently, we do think inflation is significantly below the underlying target, and therefore does open up room for monetary policy to support growth.
It's very tricky, isn't it? Because India has witnessed severe drought, severe floods, climate change is such a wild card for inflation and for the policymakers at the RBI and their peers around the world. And the only thing then, Sonal, we can really be sure of is consumer and producer prices are going to be volatile. How volatile?
Well, they are going to be. I think on the food side, at least for the foreseeable future, we know that output in the current summer cropping season is looking good. The most volatile component of food, of course, in India is vegetables. But even excluding the volatile food items, actually the broader food basket is under check. And when we look outside the food basket, globally demand conditions seem to be relatively benign. So we're not looking at a massive commodity price shock either. So currently, I think there is greater confidence that the shocks are under control, and most underlying measures of inflation are suggesting that inflation is below the RBI's 4% target. Over the medium term, of course, India needs to ensure that the vulnerability to volatile food prices comes down over a period of time, and that will require a lot more investment in things like cold storage, infrastructure, etc. So those are, of course, the longer-term game plans that need to be implemented.
So we're getting more lines from the Prime Minister. Indian farmers, fishermen, cattle rearers are our priority, Narendra Modi says. And he goes on to say that we will stand like a wall against any policy that hurts them, and we will not accept any compromise that hurts them. This tells me categorically that India has drawn a very clear red line around the domestically sensitive farming sector, and it's not going to concede any market access for the US.
I think that's been a clear and firm stance from India's side throughout the negotiations, that the genetically modified crops and dairy are essentially red lines for various reasons, including political reasons. So really the negotiations have to be on other aspects. And I think, one observation is that many Asian countries have red lines on agriculture, and that did not stop them from actually concluding a deal with the US. So, our sense is that the friction with the US is clearly not just about trade related, but what's going on outside trade on the geopolitical front.
August the 25th is when the US negotiators will be in country for the 6th round of negotiations. So what could concessions, a compromise, a workaround look like, Sonal? India's not going to concede any ground on agriculture. We've established that. Is it going to make a commitment to buy less Russian oil and therefore more US energy and more US arms? Does it come down to that? Is that the trade-off?
I think to start off, there needs to be communication at the top level. There's a lot of negotiation happening on the ground between the trade negotiators, but we really need communication lines to be open at the top level. I think that's the starting point. Now, in terms of what more India can offer, I think outside agriculture, in the industrial products like autos, alcohol, where US wants to access the Indian market, India can offer a faster pace.
Select market access.
Select market access. They can, but the broader tariff list will include over 90% of the products actually seeing the tariff lines come down. So across industrial products, there can be faster, pace of reduction in tariffs. India can buy a lot more of US oil going forward. Even on the defense side, partnership, I think, is feasible. So there are areas on which the two sides can negotiate on the trade front. As far as Russian oil is concerned, I think the Indian government has made its stance very clear in terms of, energy security is very important because India needs a lot of oil. And so the question is there a risk that global oil prices move up if India shifts to other kinds of oil, and how feasible it really is?
More higher priced oil.
More higher priced oil. So I think those considerations also need to be kept in mind.
So herein lies the risk. If both sides, if 50% tariffs stick, how destabilizing could it be if India faces a far higher oil import bill? Are there inflationary ramifications here and growth concerns?
Growth concerns for sure. I don't think there are inflationary ramifications. So, the Russian oil discount has narrowed substantially. So we've gone from over $12 per barrel 3 years back to the discount now being less than $2.50 per barrel. So if there is ample global oil spare capacity, then our estimate is that the cost of switching over to some other oil is going to be less than $2 billion on an annual basis, which is essentially, significantly less than even 0.1% of GDP. So that can be done. But the economic cost of a sustained 50% tariff will be substantial. So excluding pharmaceuticals and electronics that are currently not tariffed, the biggest export categories, which are textiles, gem and jewelry, leather garment, marine products, these are the sectors where the hit to US exports could be easily 30-40% in terms of the future export orders. And these are labor-intensive sectors. So there will be second-order effects. If the 50% sticks, then our estimate of the direct economic hit to GDP growth is about 0.5% of GDP on an annualized basis, plus there would be some second round effects as well. Over the medium term, though, this is a cost-benefit analysis, not just about FY26, yes. And I think that's important to understand. This is an analysis of the cost-benefit analysis on economic and geopolitical front for India over the next 4 to 5 years, and it's a tough decision.
And just on that, it just feels like President Trump is willing to throw India relations and an India trade deal under the bus in order to get a big win with Ukraine and ending the war there. It feels like US-India relations may have been irreparably damaged, which is why India seems to be aligning more closely to the BRICS and unthinkably with China, which was at one point a huge strategic adversary. Is that what is going on?
I think this is clearly a unilateral decision taken by the US. This is nothing that is of India's, decision making here. So China, which is the biggest buyer of Russian oil, has been, not at all been imposed any tariffs on. And as the Indian side has said, US and Europe have also been buying certain Russian products, including uranium. So I think from India's perspective, the economic sovereignty issue is quite important, and the ball is in the US court in terms of whether they want to escalate or de-escalate. India has taken a more defiant stance that will have some economic hit in the short term, but ultimately, if every country is focused on their national security and their national priority, why will India not do the same? And that is what's really happening here. But I think over a medium term, clearly India needs to diversify its risk in terms of finding newer partners on the export side, and even on the geopolitical front in terms of having good relationships with countries within BRICS. But, all said and done, I think, at the end of the day, one hopes that cooler heads will prevail.
Indeed.
And the decades of India-US strategic relationship will not be thrown under the bus.
One hopes so, but President Trump has made his antipathy towards the BRICS very well known, especially what he perceives as de-dollarization efforts. Turning to India, do you feel that the RBI has successfully defended the rupee now through its timely interventions and saved it from hitting an all-time low, or do you think that depreciation risk is still inherent in the exchange rate?
So near term, I think it was important for the RBI to control volatility, because otherwise it sends a negative signal for investors in terms of sentiment. Over a period of time, one could argue that a bit of currency depreciation might be what the doctor ordered to offset the tariff impact. But the cost from there in terms of any imported inflation, higher cost of borrowing has to be kept in mind. So it needs to be more gradual as a strategy going forward. And of course, this is going to depend on how the global dollar side also plays out. So I think the weekend meeting in Alaska is going to be quite crucial.
Sonal, always a pleasure talking to you. Thank you very much indeed for joining me on Inside India. Sonal Varma there from Nomura. Now, in the meantime, we were just touching on this, a thaw in India-China relations. Chinese Foreign Minister Wang Yi is expected to visit the capital, New Delhi, on Monday, with talks likely to focus on the India-China border issue, tariffs and bilateral ties. Staying with China, we got some fresh data this morning. Elaine Yu joins us now to tell us what the numbers indicate for the economy. Pulling out of deflation, Elaine, or still mired in deflation?
Sri, yes, the economy is delivering a sobering reality check, and it is slowing more sharply than anticipated in July. Industrial production grew at the weakest pace since November at 5.7% year on year, and missing estimates. And retail sales managed a 3.7% growth, but that's the slowest this year. And also fixed asset investment decelerated to just 1.6% year to date. And that's the worst slowest pace since the pandemic. So we see an economy under strain, and it's a different narrative from the first half of the year where we saw stronger than expected performance. So the industrial slowdown confirms that the temporary boost from the U.S.-China trade truce is now fading, and that the front-loading effect is reversing. And Morgan Stanley's Robin Singh was on our program earlier calling this growth payback. And the government also said that China's exports are facing pressure due to external uncertainties. And the consumption figure is also the weakest growth this year, and that shows that consumers are worried about their jobs, their homes, and the value of their homes. But also in July, we saw bouts of extreme weather, floods, and high temperatures that disrupted consumer and construction activity. And the government said that the weather events did create a short-term hit to economic growth in July. But the question is, how forcefully will policymakers respond to this? But we do see momentum softening, and that the second half of the year will shape up to be much more challenging as China navigates choppier waters. Sri, back to you.
Elaine, great reporting. Thank you very much indeed for that. Now, India's Prime Minister Narendra Modi continues to talk about reform and new schemes during his Independence Day address. We will talk to former RBI Governor Raghuram Rajan about all of this and more after a short break. India marks Independence Day, and let's just take a step back in history and take a look at what happened. Remember, back in 1947, India stepped into freedom, a new nation with an economy scarred by colonial rule. Poverty was widespread, industry scarce, and agriculture was still the backbone of the economy. By 1951, the first five-year economic program took shape, the goal industrial growth and self-reliance. But in 1956, the dreaded License Raj emerged, a system where businesses needed government permits for almost everything, and it aims to control resources but also slowed the pace of private enterprise. The 1960s brought the green agrarian revolution, high-yield seeds, better irrigation and new technology, turning India from a food deficit nation to self-sufficiency in grains. After the wars, with China in 62 and with Pakistan in 65. The Indian rupee was devalued for the first time, a move to boost exports, but one that also made imports costlier. 1975 came the emergency. Prime Minister Indira Gandhi imposing a 21-month political clampdown, disrupting the economy, industry and everyday life. 1986. India's big bang moment of financial deregulation came. The BSE, the Bombay Stock Exchange, launched its electronic trading system, ushering in the modern capital markets. But the real turning point came here in 1991. Facing a balance of payments crisis, India opened its economy, ending the licence Raj, inviting foreign investment and unleashing private enterprise. The dawn of the century brought yet another war with Pakistan, the Kargil conflict straining the country's budget. And then fast forward to 2016, India demonetized its currency notes of 500 and 1,000 rupees that were in circulation. That move caused chaos throughout the country, but it did also accelerate digital adoption. 2017, GST, goods and services tax, replaced a patchwork of levies with one nationwide tax system. And we heard the Prime Minister talk about reform on GST. And in 2020, we all know what happened then. The COVID pandemic hit hard, growth slumped, jobs were lost, and digital adoption accelerated like never before. So this is the scale. Let's take a look at the next representation of growth in India has seen since the 1960s, the oldest data that's available. And just look at this perspective. Today, the economy stands at about $4 trillion. By 2047, and the Viksit Bharat development goals, India is aiming for $5 trillion, aims to be a $5 trillion economy and will hold the title of the world's third largest economy after the US and China, and would require an annual growth rate of 8 to 10%. So very ambitious long-term development goals and targets. India's current GDP, by the way, stands at around 6.5%. And today, from the Red Fort in the capital, New Delhi, Prime Minister Modi reiterated how India aims to grow by being self-reliant.
To be self-reliant, one has to be constantly aware. Self-reliance is not limited to trade and forex. Self-reliance is related to our capabilities. Our capabilities also reduce when self-reliance weakens. That's why, to protect and increase our capabilities, it is important to be self-reliant.
Let's talk about India's purchases of Russian oil, the reason why the country is facing 50% tariffs from the United States. But that doesn't seem to be unduly phasing it. The chairman of Indian Oil Corporation says there's no pause in imports from Russia and that buying decisions are purely economic. The top boss of the country's largest oil firm also said the government has not asked them to cut or increase purchases. Separately, state-owned Bharat Petroleum is expecting Russian crude to form 35% of its imports in the current fiscal. Despite the discounts coming down, BPCL imported a third of its crude from Moscow in the last quarter. Meanwhile, reports also indicate that it bought 10 million barrels of US oil. No comment from the company on that, but Indian refiners have also been increasing their US energy imports as part of an agreement struck between Prime Minister Modi and President Trump back in February. I'm delighted to say Raghuram Rajan joins me now, Professor of Finance at University of Chicago Booth School of Business. He is also, of course, the former Reserve Bank of India governor. Raghuram, welcome to the programme. How would you characterise the balance of risks on the external front or on the domestic front facing India at the moment?
Well, these are difficult times for any country, given the disruptions created by the new US administration and its worldview, which differs a lot from that held by previous administrations. So every country has to figure out how to navigate this. Clearly, India has been hit hard by the size of the tariffs, 50% as of now. I would hope that this is not a permanent state of affairs. It's a call for negotiations and that over time, we get to something which looks a lot more reasonable. India was banking on the friendship between Prime Minister Modi and President Trump. That doesn't seem to have played a part in these in the tariff setting. But that said, U.S. exports are $80 billion goods exports. India imports about $40 billion from the U.S. But it is a 4 trillion economy and growing at 6.5%. So yes, it will be impactful, but I think the question is not so much this year's imports and how that's exports and how that's affected, but really how this affects the long-term trajectory of Indian growth. To what extent does it become a goods exporter, substituting in some small part for exports from other countries in the region? So we'll have to wait and see. I mean, India wants to become a manufacturing export leader. It certainly is doing very well on services exports. The question is, can it recover its mojo on the manufacturing exports? Can it do a deal with the United States, which will be a big part of that?
How confident are you in the Viksit Bharat longer-term developmental targets of 2047 and India's aspiration to be the third largest economy after the US and China and to be a $5 trillion economy? How achievable is that, Raghuram?
I think you should probably add a zero to that. So we're talking 50 trillion by 2047. India, at 4 trillion right now and growing at 6.5%, is probably going to overtake Japan and Germany if it hasn't already done so. At least Japan, there's some talk based on World Bank statistics that it has overtaken Japan. But we're talking maybe a couple of years before India becomes the third largest economy. But that said, it is way behind China and the United States in terms of size. And so it will take a lot more growth, not just to get anywhere near those two economies. That's going to take a long time. But more important, for India itself to become, upper middle income. India wants to do that before it starts getting old. And its population dividend, the fact that over the next few years, you're going to see the size of the population that is non-working, that is dependent, shrinking as a fraction of the population. In other words, more and more people are entering the workforce. If India can provide jobs for them, India can grow at a faster pace than it's growing right now. But that's a big wave. The big challenge for India in the next few years is how to employ the young people coming into the labor force.
And this has been addressed by the Prime Minister. He's talking about a youth employment scheme. So, Raghuram, do you feel that India at a policy level is enacting the reforms and the changes that are needed to really scale jobs for the younger generation of graduates? Because right here and right now, there is a concern that quality, high-paying jobs are not being created.
No, it's a very fair question. And just take the ambition of becoming a developed country by 2047. That means a very high per capita income. And to do that, India has to grow at least a couple of percentage points faster than it's growing now, but also in the process create many more good to very good jobs. And that requires a lot more effort, a lot more reforms. Undoubtedly, India is reforming. It's a continuous process, has been the case since 1991, which you pointed out. But it's not enough at this point. And we really need a whole new generation of reforms to light up the Indian engine of growth. And I think that's something that we really need to think afresh. because incremental stuff is not going to give us that 2.5% that we need. We really need to take the opportunity, perhaps, of these challenging conditions.
Yes.
The whole world sort of turning more goods protectionist and figure out what might work in this environment.
So what's going to kick off that virtuous cycle then, Raghuram? Because there are some who feel that perhaps India is expending too much political capital on pursuing trade deals. But does the answer lie there with trade deals and the FDI that comes with it? Is that going to supercharge job creation and India moving up the value chain into advanced manufacturing?
Well, I think you start first with India's greatest strength, and that has to be its large number of people and a large number of very young people. And if we can train them up, if we can skill them up to much higher levels, then I think we have the raw material for moving ahead. So I would focus first and foremost on improving the quality of India's human capital. Yes, we have a Satya Nadella or a G.V. Ramakrishna, a Nobel Prize winner, or Abhijit Banerjee. But we need many, many more Indians to have the kind of education which prepares them for those kinds of careers. And that needs a lot more work, not just on higher education, needs more primary education, more healthcare, better access to financial services. So we need the gamut of human capital-oriented reforms. But also, I mean, some of the old sort of needs are still there. India's bureaucracy is a little too active. We need to cut the red tape a little more. And, states are engaged in it. The center has promised a commission which will cut red tape. But we need to do all this yesterday. We need to create that playing field. And what is heartening is, some states are actually reaching out to attract foreign investment and telling investors, look, we will cut the red tape for you. Let us take care of it for you. And they're creating organizations to help investors. So there is movement, but we need a lot more of it.
Yes, it's interesting. You note it's happening on a state-by-state level. And we recently were speaking to the Chief Minister of Andhra Pradesh, who was here in Singapore, looking to scale Singapore investment into the state. It is, again, Raghuram, do you think government capex programs and spending, which continues to be such a key driver of the broader economy and economic activity, needs to perhaps take a back seat? Because it's not really crowding in the private sector, is it? At what point is that going to happen?
It's not, and it hasn't happened for some time. To the government's credit, whether state or national, there's been a lot of infrastructure spending. The quality of India's infrastructure is so much better than it was, say, 10, 15 years ago. But that, as you said, won't cut it. That can't be the only thing that happens. And that is why it is extremely important that the private sector also starts stepping in. Private sector investment hasn't really picked up to the levels that it was before the global financial crisis, despite the strong growth in India. And what's more, what we need is private sector ambition. We need India's firms to want to be world beaters again. They had a little bit of that in the early part of the century. After 10, 15 years of reform, Indians actually felt they had world-beating companies and were prepared to go head-to-head with global companies. That somehow has died down and needs to pick up again. Our young entrepreneurs have that. You talk to young Indian entrepreneurs, they want to beat the world. But our older entrepreneurs seem to have lost a little bit of that ambition, and they need to recover that.
And look no further than IT services, which is going through, dare I say it, something of an existential crisis at the moment. When you look at TCS shedding 12,000 people, ostensibly because of AI displacement. So herein lies the challenge, Raghuram. Is AI such a double-edged sword that it's a challenge or an opportunity, and has IT services really figured out which one it's going to be?
Well, it's both, of course. It is going to be a challenge. Low value-added services are going to be very hard to sell. You're not going to have a lot of legal discovery once you can be confident that AI will not hallucinate and will give you the citations that you need to prepare your legal brief. So that's here, or it's almost here. And so if you're going to do legal discovery and just base your services on that, that's not going to be enough. You have to add value to that. And that goes for many services, but it also goes for manufacturing, where robotics is getting a lot better. Automation is getting much better. And today, even in India, you don't have assembly lines with too many workers. There are lots of machines on those assembly lines. So it's a challenge for every country, but it's also an opportunity that you can do so much more with this tool. And that's where India has to focus on training up its people. Our young people are adept at working with AI tools, for example. They can be very creative. So we need more of them to feel comfortable and then participate in a global labor force, which today can work across borders with the help of technology.
And this is a global challenge, isn't it? And it comes down to education, education, education. Now, Raghuram, how stark would you say is income inequality, especially between the rural economy and the urban economy? Is that narrowing? We are hearing a lot about a recovery in the rural economy because of the abundant monsoon. Having said all that, though, are there still issues? Are there still disparities when it comes to access to affordable housing, access to healthcare, access to education we were talking about? And how is the government resolving these issues?
That's a great question. I think the disparities do exist. They've narrowed because of a couple of good harvests. But, if you look at productivity in agriculture, and the incomes available in agriculture for the masses in agriculture, it's not high. Yes, India is increasingly doing horticulture, dairy, value-added agriculture. All that is happening, and that's good. But still, there is a productivity difference between agriculture and services, agriculture and manufacturing. And as you said earlier, we're not creating enough good jobs there. But I think what is possible is really, one, we can create higher level jobs. These are the university educated consultants who can roam the world. But we can also create moderately skilled jobs because India has a lot of people who need services, who need also some goods. But think, for example, of a typical Indian village. That's about 8,000 to 10,000 people. They need things like auto repair, they need mechanics, they need plumbers, they need carpenters. There's a lot of services which can be provided as India sort of urbanizes more. And so we shouldn't be thinking only of manufacturing and manufacturing-led exports. That is the story of the last 20 years for East Asia. But we need to think of the next 20 years. And for India, it may be much more high-skilled services to be exported to the rest of the world using new tools like AI and so on, but also moderately skilled services for domestic consumption, for the domestic population. That's where the jobs will be.
Raghuram, we heard from the ratings agency S&P and a credit rating upgrade for the sovereign of India. A nice Independence Day birthday present, perhaps. Was that justified and well-deserved?
I think yes, because, if you look at India's fiscal situation, I mean, through the pandemic, yes, there were demands for spending, but the spending was targeted, for example, free food grains. And you look overall, I think India has managed to keep some fiscal discipline. It's a large, diversified economy. Even the tariffs from the United States will affect maybe 2.5% of the economy. So it can survive shocks. But I think this is a reward for reasonable management, but it's a part grade upgrade. So I think we need to, again, repeating myself, we need to look into the future and look for far more
Absolutely.
growth.
Where are the policymakers in all of this at the RBI and the Finance Ministry, Raghuram? Have they done enough, or does the fiscal and the monetary impulse perhaps need to be stepped up, given the balance of risks out there?
Well, I think I won't comment specifically about the RBI, but it is true that in this environment of the U.S. taking in less going forward, probably over the next few quarters as demand slows down in the U.S. for the rest of the world's goods, there will be space for central banks and the rest of the world to cut interest rates. And in India, inflation has been relatively muted. I won't comment on what the RBI will or should do, but I think across the world, space has been opening up. On the fiscal side, India needs to maintain fiscal discipline. So it's not so much about increasing spending as changing the nature of spending. And this is where I think over time it has to move towards far more on public services like health and education, improving their quality. That is where resources have to be put, because certainly what we need is better human capital.
Agreed. And we need to transition the future workforce to this new world of AI in the fourth industrial revolution, which is how it's being characterized. Raghuram, always a fascinating conversation with you, sir. Thank you very much indeed for those insights and for joining me on Inside India. Raghuram Rajan there from University of Chicago Booth School of Business. Now, I do commend you to subscribe to our weekly newsletter to find out more about what's happening in India and the stories shaping the country's economy and markets. Do scan the QR code on your screen to become a subscriber. I'm afraid that's all the time that we have today on Inside India. Do keep watching CNBC. Access Middle East is up next.
Prime Minister